Hello and welcome to Know Your Company. In fact, why are we talking about one of the major defense players in the country? I am Hiral Dadia and with me is Anushi Vakharia. Anushi, good afternoon. An interesting play that we are going to talk about.
Absolutely.
Let's quickly understand a premier explosives in trade. If we can pull up the next slide in terms of why are we talking to premier explosives. Firstly, they are increasing their focus with regards to where the defense business goes. So the outlook going forward becomes absolutely crucial from here on. Moving on, the other points we need to consider is why the bulk explosive business is facing pressure this time around and what are the levels that margins and growth will sustain. So these are the three parameters that we are looking at. Apart from that, the key orders to keep track on going forward, that's the fourth point. And on number 5, the capex plans and the debt picture. What is interesting with the premier explosives from here on? Overall, if you have to talk about the rating parameters as well and in terms of what the company does. Firstly, what is interesting is the execution of the 750 crore order book. Now, whether that will be able to drive revenue growth and especially the acceleration we could see in terms of the defense orders. India's defense indigenization and global explosives market, that is a favorable backdrop for this company as well. But the persistent delivery delays or any operational incidents like the one where we saw a fire at one of their units, will that go ahead and put pressure in terms of any businesses or not? And whether the kind of downtick that we've seen in terms of margins will act as a deterrent is what we need to understand from here on. Very quickly, let me take you through about the company in terms of what the company does as well. Overall, it is manufactures industrial explosives and detonators. Apart from that, in terms of the business, if we can just go to the next slide as well to understand the other details, it serves mining, infrastructure, defense and the space sector. These are the sectors where Premier Explosives operates with as well. In terms of the product profile, bulk and packaged explosives is what they are looking at. It makes cast and emulsion boosters and supplies detonators and detonating fuses. And overall, I think 6 manufacturing units is where Premier Explosives is sitting at. If you talk about their defense products as well, a solid propellant manufacturer since 2003, and they've remained the only private Indian supplier of missile propellants. And they supply this to Akash, Astra, LRSAM and Pinaka rockets, and they are producing explosive bolts, pyroactuators, smoke markers and cable cutters. If you have to talk about their key order wins as well, in the fourth quarter, they've received orders from BrahMos, which aerospace, and the casts, propellants and assembled BrahMos, Ramos boosters as well. So that's with regards to what, the company has been doing. And then very lastly, the segment mix, if you go to see, the bulk explosives, which is still a small portion, did see a degrowth, but the defense space, which is almost 81% of their portfolio, has seen a 82% growth. So clearly the focus in terms of the companies, in terms of the defense space and indigenization is the key. Whether they are able to meet expectations or not, Anushi, is the key question from here on.
Hiral. So for that, we have to talk about the key metrics which are there, primary explosives, as you've just mentioned, that a lot of the business coming in from the defense segment, BrahMos being a key order to keep a track of. But how have the financials shaped up? That is something that we should be watching out for. In terms of where the income statement is concerned, overall, if we take a 3-year perspective, they have seen about a 28% of a revenue CAGR growth. Do bear in mind that even in terms of where the FY25 number is, it's more than a 50% of a growth, almost above 40% of a growth that we are looking at in terms of revenue. EBITDA, however, a sustainable margin for this one we should keep our eye out for. Now in FY25, the margins dipped to 14% as compared to 22%. There were issues on some order delays which led to these liquefied damages that we are looking at which company does expect to reverse. So what's the kind of trajectory? 18 to 20% is the range that the management expects going forward. But how is that sustainable overall is something that we'll keep an eye out for. Net profit on a solid base of FY22, if we see from a 6 crore company, it has grown to 29 crore. So 68% of a CAGR growth is what we are seeing. In terms of where the order book is placed, now in March 25, we've seen the order book of around 750 crore, which implies a book to bill of around almost about 1.8 times. Now, considering that from the previous years, that has downsized a bit as compared to a 2.5 to 3x of a ratio that we are looking at. So, going forward, while the management did say that they expect to maintain this 800 crore of an order book going forward, it's the execution which we'll ask the management about for more clarity on what's the kind of trajectory in terms of where the order inflows are concerned. So, given that parameters in mind, we have given this a neutral rating for now, right, Hiral?
Yes, so let's move on to the balance sheet. Interesting why we need to look at this one is because if you talk about the various metrics from the equity, book value, borrowing and cash bank, what stands out right now is the borrowings. If you see the trajectory, it has been on the reducing end, which is a positive. Secondly, if you have to look at the cash in bank, that is seeing an increasing trend from a 7 crore in FY23, you've gone up to almost 101 crores in FY25. So that is also a positive. And after calculating your debt to equity, that has been improving. So these are the three positives that we're seeing in terms of where the balance sheet goes. And that's the reason why NDTV Profit has given it a thumbs up.
Right. So, if you talk about the cash flows, however, while even balance sheet will given it a thumbs up, even for cash flow, a thumbs up is what we are seeing. Now, just take the last 3 years in trajectory. From 21 crores of cash flow from operations, they've seen a healthy growth, 79 crores to 118 crore of a figure that we are looking at. Taking that in context with the EBITDA levels also, this ratio has just seen an improvement from those levels. So, how the management expects to utilize these cash proceeds, these cash flow from operations is something that we can keep an eye out for, even from net cash flows, which were almost negligible in the red in FY23. Now, FY25, this stands at 73 crores. So, it's an improvement in terms of where the cash flows are also headed for the company, right, Hiral?
Yes. So that's a thumbs up coming in for cash flows, and another thumbs up in terms of the return ratios. The reason why we say this is, if you talk about the return ratios, that's the return on capital employed and the return on equity. It's on an improving trajectory. In terms of ROCE, 13% is where it's maintained at in the last 2 years. And if you look at the next one in terms of return on equity, that has come down slightly in terms of FY25, but overall trajectory is still in terms of double digits, and hence a thumbs up.
Okay, so that is in terms of the return ratios that we are seeing overall trend shaping up from 4% to 13% for ROC, ROE 3% to 12%. But let's also take the shareholding in perspective. Now, overall promoters, there's no surprise over here. It's remained stable at the levels of 41.3% or so. But it's the FII stake and the DI stake. Now, FIIs, if we are looking at, it's almost negligible. What was at 0.2% has moved slightly upwards to the levels of 1%, while DIIs, 3.4% was the stake that they held in March 23, which increased to the levels of 10% and has from there on come down to 8% in 2025. This is the latest figure that we are seeing. In terms of where the public shareholding is concerned, it has more or less remained in the range of 50 to 55%. Is what we are seeing. So, overall are neutral in terms of where the FII and the DII stake is concerned for the company, while promoters, we are not looking at a significant change over the course of these last 3 fiscals.
Absolutely, and you know, whether the FIs and DIs will increase in the company or not is going to be the key thing to look out for from here on, Anushi, because overall, the moment you see skin in the game from institutional investors, that's when you understand that yes, there is something probably in store from a business perspective. But let's understand what the markets are reading this. In the last 1 month, you've seen a 23% up move in terms of Premier Explosives. However, you know, it's the entire defense pack which has been on an uptick. So that is something that we need to take with a pinch of salt. YTD, it's just a 9% up move. What's a downer is, in the last 1 year, you've actually seen a downtick of 2% on the stock. A 41 times returns in the last 5 years. So that's a very strong number from a long-term perspective. But in the last 1 year, the stock's not really done much, and hence a neutral rating so far, Anushi.
Hiral, you know, in the last 5 years, it's been a multi-bagger for the investors out there. But taking the valuations in consideration, can we expect the same going forward? Because if you look at the current P multiples, now that is almost at it's almost up over 100 times. It's at 113 times is what we are seeing. Even the 3-year average, if we are taking in context, that has not been cheap for the company. 97 times is what the ratio is what we are looking at. So overall valuations more on the steeper side that we are seeing for this business. So considering that parameter in mind, we've given this a thumbs down on the valuation front.
Absolutely. So valuations are seeming absolutely expensive, but let's understand from an outlook perspective from here on. If you have to look at FY25, what they've said is there have been some damage charges that impacted the margins in the short term. Though what number do they maintain going forward is going to be interesting. Secondly, their April 25 explosion which happened at the propellant mixer unit at Kattapalli, that is what has resulted in a plant closure. So you will see a revenue loss also that could be coming in from that aspect. And they're estimating a revenue loss of almost around 25 to 30 odd crores in FY26. That's what the management has indicated. And if you talk about the bulk explosive business, that is facing margin pressure. The reason being the raw material inflation is what they are seeing, and the lack of Coal India orders, they are not coming in. So these have been few of the concerns that the management, Anushi, have highlighted for FY25. But anything that you've picked up in terms of what FY26 could then look like?
So while FY25, a couple of these concerns I've allied over the what has happened. Now we did see a recent update in terms of what could be happening with the plant which had been closed because of the explosion that had taken place. So, so a fresher update on that is something that we should be watching out for. Other than that, in terms of where the longer picture is considered, the management does expect to maintain an order book of 800 crore, roughly almost the same as what we saw in FY25. So 50 crore of a growth here or there. They're expecting a lot of additional orders flowing in for the company. So it's the how are the order inflows shaping up is something that we'll keep an eye out for. Top line, they see about a 600 crore in FY26, which is up over 44% as compared to the past fiscal that we've seen, and the management also expects over 1,000 crore top line, and this is by FY30 that we are looking at. In terms of where margins are guided, 18 to 20% is the kind of range that we are seeing on a medium term basis. So overall, Hiral, this is the sum up of what we are seeing for Premier Explosives.
So let's understand now what the overall ratings are looking like as well. I think that is going to be key. Overall income statement, it's a neutral. We already explained to you why. But balance sheet, cash flow, return ratios, a thumbs up coming in there. Shareholding, street cred, outlook, again neutral. Valuations are a downtick, but that's mainly on the back of it being expensive as compared to the averages that we've compared. So on an overall basis, it's a 5 on 8 that NDTV Profit has given Premier Explosives. The key over here is going to be whether after the conversation with the management, what is it that will probably get the company to a 7 or even a 8 on 8 from here on. In fact, joining us on the show is we have Mr. TV Chowdary, MD at Premier Explosives. Mr. Chowdary, good afternoon and welcome to the show, and a pleasure to speak to you as always on NDTV Profit. My first question coming to you is, overall, we've seen that the kind of growth that you've been able to achieve so far as well, one of the key concerns have been the kind of downtick in terms of the margins in the fourth quarter, and that became a deterrent from a investor perspective as to what is in store in terms of FY26. So if you have to lay it down for us as to what are going to be the key highlights you're going to watch out for in terms of FY26, which will put away investor concerns that they had in FY25?
Yeah, thanks for having me on the show. See that we are in the business which is not commodity, but it is the quarter to quarter, the deliveries and then the priorities keep on shifting. So that's the reason why there is no consistent figure from quarter to quarter, but it keeps on some quarters it goes up and some quarters it goes a little down based on the inspections and deliveries made in there. So I think what difference you are seeing in the financial year ending 2025 in the profit margin, but achieved in the terms of turnover, that we are expecting that in the coming 2 quarters that will be made up. In addition to that, we have added the new products. We are not just a propellant manufacturing company. We also do a lot of other supplies which are contributing to our turnovers and all those, including countermeasures like shafts and flares and mines, land mines, anti-personnel and armored vehicle and all those, and also ammunition. These are expected to give better contributions in future. And also the other inflow also will increase. Based on that, we are hoping that whatever shortfall of the profit will be made up in the next financial year.
Okay, so is 18 to 20% is the right range for FY26 in terms of where the margins are headed?
Yes.
Okay, so 18 to
Mm.
20% is what is the range we are looking at. Can you further divide this between the segments? If you have to take defense in consideration or bulk explosive business in consideration, how do margins differ across these segments?
See, the defense sector, definitely it contributes the highest margin, which can come up to 25%. But other areas, that is the bulk explosives, and also we are in the service sector. If you remember, we have providing the GOCO services to ISRO. There, the margins are coming down because of it's a 10 years contract. When you start the contract, you will start with the better margins, and as the time proceeds, it reduces. Similarly, bulk explosives depends on the change in the market price and then the procurement of raw materials. So there the margins are lower. It will be something like 5 to 7%. So the defense sector, we hope that that will compensate, and the average margins will be in the range of 18 to 20. That is the basis of that figure.
Okay, and Mr. Chaudhary, just in that context, while for defense you've given an overall outlook, just want to understand in terms of where the bulk explosive businesses, if you just have to summarize FY25, why are we looking at the 7% of a downtick, and going forward, what's the outlook? Now, there have been a couple of concerns related to Coal India not giving those orders, which has resulted, along with higher raw material costs, which has resulted in this kind of an impact that we are looking for the business. So just want to get a picture on that as well.
No, I think there is a correction here. It is not that we are not getting orders from Coal India. Coal India orders nowadays, they go Coal India or Singareni, others are reverse tendering process, reverse auction, the pricing. So it is our decision. At a certain stage, we will go below, we will not go below this, we will hold this. So it is based on that. We have not taken the orders coming from Coal India because price has gone very low. And our concentration was more on the defense and rather than this level. But we have Singareni orders and we are executing those right now. Two Singareni plants are fully working, which are at Managuru and Telangana.
Mr. Chaudhary, to add to that, the key question is in terms of the order book. Now, the book to bill ratio, that is something which is on a downtrend right now. You have mentioned that FY25 is probably where it will sustain at. It has come down from previous years, and taking that into consideration, the execution parameters and the revenue guidance that you've given, it seems it does not add up. Do you think at this kind of a book to bill ratio, you will be able to achieve the revenue projections that you're looking at?
See, the year ending 25, if you remember, we had a large order of countermeasures as emergency procurement order. So, which we have accepted based on the need of the day, and also we thought that we will take up the full quantity. But unfortunately, after accepting the order, which is with the support of a Israeli company who was to provide the components, so the international maritime affairs have changed, and the deliveries, our raw material deliveries to our vendor and also receipts from vendor got delayed, due to which the LDA is applied. But everybody knows this, so we have submitted our appeal to MOD, giving the power problems, and we are hoping that that will be considered favorably. So as
Okay.
on date, that is the status. Yeah.
Okay, so Mr. Chaudhary, are we saying that the execution delays that you faced in FY25 is not something which will happen in FY26? And if that is
Yeah,
the scenario, all the
yeah.
orders that you've received so far will be on track?
Yes, except few orders which are for large rocket motors. The new recent accident is going to affect that. Like I already indicated earlier, it's around 20 to 25 crores of orders worth those. There, the deliveries may get affected because we have to do this production from our other plant where the mixer is not so big. So that definitely that will delay the deliveries. We have already informed our customers who are ISRO and DRDO and L&T and other customers. For those products, we have already informed them.
Okay, so just taking the order book in consideration, what are the kind of order inflows that you expect for this year? Some of the key orders that you are bidding for in terms of where the defense segment is concerned, or even where the explosives or shafts and flares are, if you can give us a more clear picture on that.
We are expecting another addition of around 700 crores to present order book. That is the whole financial year.
Okay, 700 crore is what you're expecting in this, in a
Yeah.
Q4, we had also seen one order coming in from BrahMos. Just want a little bit more on that front, on what this BrahMos order means for Premier Explosives. If you can give us more details on that front, and even in terms of where the order inflows, you've said about 700 crore of inflows, but if you can give us whether it's coming from the domestic side of the business or from exports, so just give us a breakup on all these key fronts.
As on date, the BrahMos order is directly placed by BrahMos Aero Defense Company, who have placed order on us. And it's definitely very important, crucial for us, for our performance. And this, I'm not sure whether this quantity includes the export plan of Government of India or the BrahMos Aero Defense. But we know that this is for domestic requirement. This quantity is placed on us, and we are expecting that further orders will come for export.
The quantum that we are looking for this BrahMos order?
Yeah, right now it is at the range of 20, 23 or 24 crores
Okay.
total order. And we are expecting further at least doubling of that quantity.
23 to 24 crore, and you expect this to double going forward. Is that what you said?
Yeah, yeah.
Also,
Yeah.
okay, so that is in terms of where the BrahMos is concerned. In terms of where the plant closure had taken place in April 2025 of this year because of the explosion incident. Just want a more clarity on that front. You did mention that 25 to 30 crore is the kind of loss that we can expect in FY26. What's the current update that we are seeing in terms of where the plant is? When should it reopen? Yeah, so about those details.
Except the production of RDX and HMX, which we have the present facility only at Katepalli. All others, propellant manufacturing or other pyro devices and all those, we have license to work at two places, that is Katepalli and Pedakanpur. So we will be meeting the requirement from our Pedakanpur plant. And this impact of this, I don't think that will be, like I mentioned, it is around 20 to 25 crores can get impacted. Other than that, all other systems will be meeting from both the places. And another thing is in Katepalli alone, we have three plants. The accident happened in one of the propellant plants. Other two plants for where the warheads and the HMX, RDX and the munitions and integration of rocket motors is happening. Those, there is no issue and those are going on. Production is already continuing there. And the other plant where the Pollution Control Board has given a closure notice, now they have lifted it. They have permitted us to start. For 3 months, temporary operational permission they have given. And after 3 months, again, they will review it and then continue to produce. So we have come out of the closure suspension.
Right. Mr. Chaudhary, one key strategic question I have for you is defense is almost around 80% of your revenues. Bulk explosives are around 19%. Now, taking into consideration, orders are usually lumpy in a defense setup, right? Diversifying revenue streams to an extent beyond defense could reduce the reliance on lumpy orders. Any plans on that aspect?
Like I mentioned, just now listed the items all we are producing and plants. That's how exactly that's how we have planned and brought in always. So we are today not just dependent on our, we cannot say we are a propellant manufacturing company. We are manufacturing these are the devices which are contributing well to the defense turnover. That is countermeasures and mines, then medium caliber ammunition, and also export of RDX and HMX. If you remember, we are also expanding our RDX and HMX plant to meet all the demands
So,
of
so,
export.
so, Mr. Chaudhary, then how much will your reliance on defense come down to if you have to look at the next 2 to 3 years? And if that is the way it is going to be, how will the margin trajectory pan out if you have to look at the next 3 years?
No, I'll correct you. Here, the dependence on defense is not going to come down because most of the turnover will come from defense only. Within the defense, reliance on one product or two products will come down, and we are already having multiple products. So that's what I mentioned.
Okay, okay. And overall, with regards to a 10,000 crore target of 2030, that's actually implying an exponential growth from the way FY25 has panned out. So do you think that's
one
being
second, please.
extremely aggressive, or is that a conservative number?
No, I'll correct you. In one of the interviews, I mentioned as 1,000 crores. I think the interviewer or the anchor heard it wrongly and they put it as 10,000 tons.
Okay, so you're
10,000
saying
crores
okay.
turnover.
No, so what is the
1,000 is
1,000
our,
crore?
yes, that is by 2030.
Okay, so 2030, you're saying 1,000 odd crores is the top line that you're targeting.
Yes.
And with
Yes.
that top line, what will be the margin number that you will see? Is it going to be at current levels, or is that going to be what we saw in previous years?
It will increase. It will increase.
To what level?
Because we are
To
going,
what level?
yeah, it should. We can assure that I think we'll be in the range of 20%. It can be more also. But that I
Okay,
think to be
but
on conservative side, I'm saying
is going to be
20%.
20%.
Yes.
Okay. So base case, Anushi, 20% is what you're looking at in terms of margins by 2030 and 1,000 crore number in terms of top line by 2030. Thank you, Mr. Chowdary, so much for joining us on the show and sharing the views. So that's an interesting conversation so far that we had with the management of Premier Explosives. The key over here is there will be some bit of, moderation that will happen from a margin perspective in FY26, and post that a 2030 target of 1,000 odd crores in terms of revenue and a base margin of 20%, which could probably go even higher, is the key that we need to watch out for. But completely out of time with that, it's a wrap on this edition of Know Your Company from Anushi, the team that put this show together, and myself. Please stay tuned for more on NDTV Profit.